There's this one huge question buzzing around everywhere, from Mumbai's financial districts all the way to boardrooms across the globe. And it's a question that affects over 1 billion people. It's all about this psychological barrier, this number that could totally redefine India's economic story. So what exactly is this 100 rupee question?
This isn't just some far-off possibility anymore. It is the central question on everyone's mind, especially as a perfect storm is battering the Indian economy. And, for millions of people, this isn't just abstract economics, it's the price of their daily life.
And here's exactly why this question is so urgent right now. The Indian rupee just smashed through to a new all-time low of 94.82 against the US dollar. This isn't just another small dip, it's a really critical new benchmark that has set off alarm bells absolutely everywhere.
So what's driving all this? Well, here's pressure point number one, the soaring price of oil. With Brent crude surging past $120 a barrel, a nation that has to import 85% of its oil, well, it's feeling some serious pain.
And then there's pressure point number two, $12 billion. That's how much money foreign investors yanked out of Indian markets in just 1 month. We're not talking about a trickle here, this is a flood of capital that's racing for the exits.
So in this explainer, we're going to break it all down. We're going to tackle that big 100 rupee question, dig into the three-front crisis that's causing this slide, see what the central bank is doing in response, figure out who wins and who loses, and finally, ask the big one. Can the rupee actually be saved?
The rupee's collapse isn't happening because of just one thing. What we're really seeing is a perfect storm. 3 powerful and very different economic forces all slamming into the Indian economy at the exact same time.
So the crisis is hitting on 3 fronts. You've got a crippling oil price shock, a massive exodus of foreign money, and a trade deficit that's just getting wider and wider. And the tough part is, while they seem like separate problems, they're all feeding into each other, creating a really nasty, vicious cycle.
India's unique vulnerability really boils down to one thing: oil. Being the world's 3rd largest importer and buying 85% of your crude from other countries means every single price hike hits hard. To put that in perspective, for every $10 jump in the price of oil, the country's trade deficit gets wider by about $15 billion. This has pushed the current account deficit to its worst level since the 2013 taper tantrum, that whole crisis sparked by fears of the U.S. central bank cutting back its stimulus programs.
And you can see the impact of that oil bill right here. Just look at that gap. While exports are kind of growing slowly, imports have just surged by nearly 15%. This huge widening chasm is putting incredible downward pressure on the rupee.
Okay, so why the $12 billion exodus? Well, it's a classic push and pull situation. Investors are being pulled away by safer, more attractive U.S. Treasury yields, which are now over 5%. At the same time, they're being pushed out of India by worries over high stock valuations, the risk that high oil prices will just crush company profits, and the simple fact that a falling rupee literally eats away at their returns when they convert back to dollars.
So, with the currency in a total free fall, how did India's central bank, the Reserve Bank of India, respond? Well, they launched an all-out firefight to defend the rupee. And they did not mince words. The RBI governor, Sanjay Malhotra, came out with this direct and forceful statement, basically signaling to the markets that the central bank was drawing a line in the sand. This wasn't just talk. It was a clear warning to anyone betting against the currency.
And this was a full-on, multi-pronged attack. The RBI sold an estimated $15 billion from its reserves, they banned a key financial tool used by speculators, and they even activated emergency currency swap lines with allies for some extra dollar firepower. All of that, backed by that strong public statement, led to a pretty dramatic, though temporary, recovery. But these huge, high-level maneuvers have very real consequences. A currency crisis of this scale creates a really clear divide in the economy. It produces some very distinct winners and some very distinct losers among everyday people and businesses.
So on one side, you have the losers. Importers, and by extension all of us consumers, face higher prices for pretty much everything, from fuel to electronics. Students who are studying abroad suddenly see their costs just skyrocket. But on the other side, there are some clear winners. India's massive IT sector, which earns its revenue in dollars, gets a huge boost to its profit margins. And families receiving money from relatives abroad suddenly have a lot more spending power.
For those on the losing end, the impact is very, very real. A student's tuition at a U.S. university has effectively gone up by 13% in the last year just from the exchange rate alone.
So a $50,000 tuition that cost 42 lakh rupees a year ago now costs nearly 48 lakh. That's a huge difference.
And what about for the winners? Well, an NRI, or a non-resident Indian who sends $1,000 home, is now providing their family with about 93,100 rupees. Just a year ago, that same $1,000 would have only been worth about 83,500 rupees. That is a significant boost to a family's budget.
So, after the crisis in the firefight, we come to the final critical question. With all these massive forces at play, what happens next? Can the RBI actually stop the rupee from hitting that 100 per dollar mark?
Putting this into historical context is so important here. You see, the rupee has been on a long-term slide for years. But what's really alarming people is the acceleration. It took 13 years for the rupee to go from roughly 40 to 80 against the dollar. Now it could take just a couple of years to get close to 100. The pace of this decline is the real story.
And the big banks are watching this like a hawk. The general consensus seems to be a range somewhere between 94 and 98. But, and this is a big but, look at those worst-case scenarios from Goldman Sachs and Nomura. They both see the rupee crossing 100 if oil prices spike up to $130 or $150 a barrel and just stay there.
Now, the RBI isn't powerless in all this, not by a long shot. It's armed with $580 billion in foreign exchange reserves. That is a massive war chest, the fourth largest in the entire world, actually, and it's enough to cover over 9 months of India's imports.
Which, of course, leads us to the ultimate question. Is $500 billion really enough to hold back the tide of global market forces? The RBI can absolutely slow the fall, but fighting the market is incredibly expensive, and if you look at history, it's often a losing battle if the underlying problems don't get fixed.
And that's what it comes down to. Ultimately, it all circles back to oil. The RBI's intervention is buying time, but it can't change the fundamental economic reality. If oil prices stay high, the pressure is just going to be relentless. You can't permanently defend a currency when the core fundamentals are working against you.
So what's the ultimate takeaway here? Honestly, whether the rupee hits 98, 100, or 102 is almost secondary. The bigger truth, the thing that really matters, is that for India's 1.4 billion people, the era of a stable, predictable rupee is likely over. And that, well, that changes everything, from government policy to business planning to everyday household.
Subscribe for full-length videos on our channel. Visit Convertz.app for free live rates.